Welcome to The Economy, How Do You Measure That?, where we explore the fascinating world of macroeconomic statistics. I'm your host, Jim Tebrake, and today we're diving into a little ratio that underpins trust in the banking system, the Capital Adequacy Ratio, or CAR. Why should you care? Because this number tells us whether your bank has enough of a financial cushion to absorb losses and whether your money is safe. With me to unpack this is Mahmut, a longtime contributor to the IMF's work on financial sector stability. Welcome, Mahmut.
Thanks, Jim. Great to be here. I'm glad that we are putting the spotlight on this important topic. CAR may not be on many people's radar, but it's crucial for financial stability.
Okay, so it's not necessarily on my radar. So maybe you can explain to us, what is this capital adequacy ratio, or CAR, that you're talking about?
At its core, capital adequacy ratio is a measure to show banks' ability to absorb losses. So think about a trapeze artist performing high above. The net underneath doesn't prevent the artist from falling, but in case the artist falls, it protects the artist from hitting the ground. The capital adequacy ratio is exactly the same. So if the loans and investments go bad, it protects the banks. So simply, capital adequacy ratio is the bank's regulatory capital, the financial cushion, to its risk-weighted assets, where investments and loans are risk-weighted according to their risk profile.
Okay, so I go to a bank, I deposit my money on my local bank. Why should I really care about this ratio?
Because a high-interest paying bank may not always be the safest. If the capital adequacy ratio of a bank is very low, in case of a downturn or a market stress, this bank may go bankrupt, in which case this may trigger panic, withdrawals, or domino effects. And we have seen such examples in the past during the global financial crisis. A good example has been the Northern Rock, or most recently in the US, the Silicon Valley Bank, where people lined up in front of the banks desperately asking for withdrawing their money. So the CAR tells the regulators, and similarly to you and to me, how resilient the bank is. The higher the capital adequacy ratio, the more buffer the bank has. But here it's also important to say that this is not the only tool that the supervisors have to protect the system.
Okay, so we're going to work on a numerical example. You're going to help me calculate a CAR. So if I understand from what you said, there's this thing called regulatory capital. So let's assume this bank has 10 million in regulatory capital. It's a very small bank. Let's say they got 100 million in risk-weighted assets. So what you're telling me is the CAR would be 10% in this case. Is that right? And is that good, bad?
No, exactly. In this case, that bank would meet the Basel minimum requirement of 8%. With the new standard, which we call Basel III, the requirements have been further increased by introducing capital buffers. And capital buffers allow the banks to withstand further shocks. And in many countries, we also see that national regulators implement higher ratios as opposed to 8% minimum.
Okay, so I'm going to actually back up a little bit, because even when I did my calculation, I was using terms I didn't really understand. This term regulatory capital. Can you unpack that for us a little bit? Exactly what is that? What's contained in regulatory capital?
Sure. Regulatory capital is a different concept compared to accounting capital that most of our audience may know very well. And the main difference is that regulatory capital is defined by Basel Accords, and the definition relies heavily on the loss-absorbing capacity of these instruments. We have different tiers. Say, Tier 1 capital is the most loss-absorbing capacity capital that includes items like common stock or retained earnings. Or there is also Tier 2 capital, where we have subordinated debt and other instruments.
Okay, so regulatory capital is one side of the ratio. The other side is this risk-weighted assets. Can you explain that?
Sure. As you may imagine, not all the exposures are equally risky. For instance, when a bank extends a loan to a government, which may introduce very small amount of risk, in which case we may use maybe 0% or very low risk weighting amount, whereas a loan to a newly established startup company may require much higher risk weights. So in this case, risk weighting incorporates both the size and risk elements together. And to put it simple, two different banks, each with $100 million of loan portfolios, could simply have totally different capital adequacy ratios.
Great. Okay, so that takes me to my next question. So I now understand how this CAR is calculated, the different components of it. But how do countries use this? How is this really used in your world, and how does it impact my world?
Yeah. So regulators in different countries require minimum capital adequacy ratios for banks to continue operating. So falling below a certain level initiates immediate corrective action, and those actions can go as far as closing the banks. So this is serious stuff. At the same time, we can use capital adequacy ratio to compare the health of the financial systems across different countries. And our financial soundness indicators database helps users to compare these numbers across regions or across different income groups, let's say.
Okay, so the next time I open up my banking app, I'm not sure I'm going to be thinking about the CAR, but I'm certainly going to be happy knowing that people like you are calculating this.
Exactly. So financial soundness indicators like the capital adequacy ratio are signs of the health of the financial system. They do not prevent every crisis, but it gives important tools for the policymakers to promptly take action and act early. And for the people like you and me, it is where we are putting our deposits in the banks. This is something to be thankful for.
Well, I certainly am going to sleep easier at night now, knowing that when I dump my money in the bank, there's a whole range of statistics out there making sure that this bank is financially sound, that it has a financial cushion to absorb any type of crisis or stress that it might see. Well, thank you, Mahmut, for explaining this to us. Well said. The next time you swipe your debit card or check your account balance, remember, behind that moment of financial ease is a whole infrastructure of measurement and surveillance. Thank you, Mahmut, for helping us unpack this crucial indicator. That's it for this episode of The Economy. How do you measure that? I'm Jim Tebrake. See you next time.